All right, so it looks like everything is working okay. So let's get started. Thanks for joining me today for 10 reasons to start planning RMDs now. The objective, of course, is to avoid year-end mistakes and turn compliance into opportunity. Now, I know some of you started earlier this year because if you attended my earlier webinar that I did on RMDs, but there's no time like the present, as they say, right? Just some general disclaimer and copyright information. Now, let's start by talking about what is a required minimum distribution. A required minimum distribution is a minimum amount that must be drawn from an IRA or employer plan account for a year. Typically, the first required minimum distribution for an account owner is due for the year that they reach their applicable age. And we know that right now, the applicable age is 73, right? It's going to be 75 sometimes in the future. It used to be 70 and a half, used to be 72, but now it's 73. So anyone who reaches age 73 this year has an RMD for this year. Now, typically, the RMD for a year must be taken by December 31st of that year. There's an exception for that. The exception applies to the individual's applicable year. Using the example of someone who reaches age 73 this year, their RMD for this year can be taken as late as April 1 of next year. And one of the questions that I usually get from advisors is, Denise, my client's first RMD is due this year. Should they wait until next year to take it? Now, they can. Should they? That's a tax question because here's what's going to happen. If someone reaches age 73 this year, doesn't take this year's RMD until next year, they're going to have two RMDs to take next year. Because remember, I said every other RMD must be taken by December 31st of the year for which it is due. So I usually recommend bringing in the CPA into that conversation, how it's going to affect the client from an income tax perspective or any other perspective that is affected by income, right? So you definitely, this is where teamwork is important. You bring the CPA into the conversation to decide if your client should take the first RMD this year or next year. Now, if your client is a participant in an employer plan, the terms of the plan could say, oh no, we're not starting at 73. We're going to wait until you retire if you're still working. And in that case, the first R&D year would be the year of retirement. But never assume that that is the case with an employer plan, right? Because the regulations say the employer can say, no, 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 I want everyone to start at age 73. So usually, I get a question, Denise, my client is working, they have a 401k. I know they don't have to take R&D. No, you don't know unless you check. So make sure we check, right? If you have questions, please post your questions in the Q&A section. We can't talk about retirement accounts unless we talk about what's new. For 2025, final R&D regulations are in full effect. And part of what that means is the automatic waiver that used to apply to beneficiaries who are subject to a combination of the 10-year rule and the life expectancy rule, they got an automatic waiver of the excise tax if they didn't take their RMD. That's done with now. They must take their RMD for 2025. And don't forget that when you're calculating life expectancy distributions for beneficiaries, you must use the new table that went into effect 2022. And if the beneficiary inherited the account before 2021, then you got to do some backtracking to adjust the life expectancy factor that must be used to calculate the RMD. I've been testing ChatGPT a bit to see if it is as smart as my friend's calculator, and it's not there yet, because ChatGPT is still using the old rules, the old tables. And, when I say, oh, you're wrong, ChatGPT, it fights with me. So make sure when you're getting help on how to calculate your RMD, you're using a reliable calculator and consulting with someone who understands the rules. No RMDs for designated Roth accounts, and there's a new code Y for QCD or qualified charitable distribution. A common complaint was, oh, my client takes a QCD, but it's reported as a regular distribution. Now I'm going to have to fight with the IRS to help them to understand that this is a QCD. Well, good news, there's a new code, code Y, that applies effective this year. But because it's new, the IRS has said it's optional for IRA custodians. So don't fight with the custodian if they didn't use code Y for this year, right? The code Y can be used for traditional IRAs, inherited IRAs, can't be used for Roth accounts. So again, here we are where Roth accounts have been forgotten when it comes to IRS compliance requirements. But let's see if they change that for next year. Here's what some advisors are telling me they're struggling with. They get an RMD calculation, they ask me to check it, we find out that it's wrong. Why would that happen? Maybe the IRA custodian has incorrect data online. Maybe they're using the wrong life expectancy table. Inherited IRA rules are changing, and advisors are confused, as well as their clients, about which rules apply. Who does a 10-year rule apply to? When does annual RMD requirement kick in for a beneficiary? And clients are misunderstanding and ignoring RMD notices. Those clients are probably like me. You know, if you right beside me right here is a pile of mail that I need to open, and I never get to it. And for those clients who are like me, unfortunately, the required minimum distribution notices are sometimes in that mail. So, you know, remind your clients when you run that report to say who sent the three, have they taken their RMD? Reach out to those clients and ask them, did you get your notification? And have you taken your RMD? Because remember, for IRAs, the RMDs does not have to be taken from the account that you're holding for a client. It can be taken from an account that is held elsewhere. Confusion about which distributions count as RMD. There's a myth that all distributions during an RMD year counts towards RMD. That's not true. So you got to double check to find out. Or for instance, is it a return of excess? That doesn't count as an RMD. Is it a loan that's treated as a deemed distribution? That does not count as an RMD. Here's another big one: uncertainty around QCD timing and reporting. That usually comes into play when a client wants their QCD to count as RMD. I'll talk about that. And of course, 10-year rule inconsistencies and compliance risk. Just a little bit about me. I have a feeling that everyone who's on the line right now knows who I am. I'm a national IRA expert, and financial, tax, and legal professionals come to me when they want answers quickly and they want answers that are accurate. So, why are we here today? We want to talk about why early RMD planning is essential. November, is it early? Technically not, but kind of sorta. We're going to look at some common RMD pitfalls and how to prevent them, and use RMD planning to create meaningful client opportunities. So let's start with the essential. When advisors say to me, why should I be bothered with RMDs? I probably don't have any client who's taken RMD. Well, when you think about the fact that over 4 million Americans reach RMD age every year, if you manage IRAs at all, I'll bet you $10 right now, $5 maybe, that you have at least a couple accounts where your clients must take required minimum distributions from those accounts. And remember, when we're talking about required minimum distributions, it's not just about account owners. It's about beneficiaries too, because depending on the class of beneficiary, depending on whether or not they're subject to the life expectancy rule, and depending on when the beneficiary inherited the account, that beneficiary might need to take required minimum distributions as well. For instance, if your client inherited an account in 2019 and they're subject to the 5-year rule, they might need to take RMDs this year. Let me see if I'm counting that right. 2019, 21, 22, 23, 24, 25. Yeah, because remember, we're not counting 2020 because of the RMD waiver when we're counting the 5-year rule for beneficiaries. Pretty interesting statistics on this slide, right? An estimated 73 million baby boomers are in the second largest age group right now. So, very likely you're going to be getting questions from some of these baby boomers about what's an RMD, what should I do, how can you help me? And hey, I go to church every Sunday, I make a donation. Can I do that tax free if I do it as a QCD? Don't forget too that the IRS is increasing their focus on required minimum distributions. People will ask me, well, how the IRS is going to know that my client is supposed to take a required minimum distribution? Well, take a look at IRS Form 5498. There are about 3 spots on the form that IRA custodians can input data to tell the IRS that an individual is supposed to take a required minimum distribution for the year. And so the question that the client should really be asking is, well, what do I do to make sure that the IRS doesn't put their eyes on me, asking me, where's my required minimum distribution? Or if I don't take my RMD, how is that going to affect me? Because we know that if someone doesn't take their required minimum distribution, they're going to owe the IRS a 25% excise tax on the RMD shortfall. It used to be 50%. It was reduced to 25% on the Secure Act 2.0. And good news, if the correction is done during the correction window, if the shortfall is done during the correction window, the excise tax is reduced to 10%. So that's another reason to say to your client, well, you're going to owe the IRS a 25% excise tax if you didn't take it on time. But guess what? If you do correct it on time, then it's reduced to 10%. And also, if you miss it for a reasonable cause, the IRS will waive the excise tax if you ask them properly by filing IRS Form 5329 and explain to the IRS why the deadline was missed. So here's the top 5 RMD mistakes that I see. Miscalculating the RMD amount. And this could happen at the custodian level or at the client level. I have a lot of clients who feel that there's enough information out there for them to figure it out on their own, so they don't think they need a financial advisor. I'd say about 90% of the mistakes that I'm asked to fix are mistakes that are made by IRA owners who think, I don't need a financial advisor. And when they find out that they make a mistake, then they go see the financial advisor to try to help them fix it. Accounts that cannot be aggregated. I'll talk more about aggregation in a little bit. Missing the RMD for the year of death, applying the wrong beneficiary rule, and attempting to do Roth conversions and rollovers before taking RMDs. We can't do that, right? So that's a lot of things to think about when it comes to RMD, and we haven't even scratched the surface yet. So my question for you is, are you ready to handle your client's RMDs right now? Because December 31st is around the corner. And we got to remember that even though the deadline is December 31st, financial institutions can implement an earlier deadline. And many of them do because they get that high volume of requests that come in December. And so my experience has been custodians who say, listen, I know that at the federal level, the deadline is December 31st, but for us, the deadline is December 15. Now, if you send it in after December 15, we're not saying that we're not going to do it, but we're saying that we'll do our best. And if we don't get to it, then tough cookie. I usually recommend getting R&Ds done before November, because you want to get at least one account statement. And for firms that issue quarterly statements, at least get it done in the third quarter. Why is that? Because you want to be able to look at the client statement and say the RMD was X amount, how much was taken, right? So then if there's an RMD shortfall, you can make corrections. And if more than the RMD was taken, then you can roll that over within 60 days of receipt, as long as they're not going to break the one per year IRA to IRA rollover rule. So early planning, more time for strategy, more time to fix errors. And, who wants to be stressed in December, right? That's holidays. We should be enjoying ourselves after working hard for the full year. So let's talk about the 10 reasons why we want to pay attention to RMDs now. The updated life expectancy factors. I can't tell you how many individuals I've seen calculating RMDs on their own, because they're those group of brave people who think I can do it myself. I don't need a software. Find out they're using the wrong life expectancy table, and make sure that if you are using an online calculator, ask whoever provides the calculator, has it been updated with the new life expectancy table? And if you're brave enough to do it manually, especially if you're doing RMD calculations for inherited accounts, remember that you're going to have to do some adjustments using the new life expectancy table for individuals who inherited retirement accounts before 2021. And verify that the custodian is using the right life expectancy factor. My experience is the only time that I find that an IRA custodian uses the wrong life expectancy factor is if the data entry on the account is incorrect, because that can happen, right? Because the person who's inputting the data might transpose the date of birth, or use the wrong beneficiary's date of birth, and that could affect the life expectancy factor that is used to calculate the RMD, especially if the beneficiary is a spouse who's more than 10 years younger. Here's another thing you want to look for. Inherited accounts, the only life expectancy table that can be used is a single life expectancy table. And I know some of you are nodding your head right now, but that is a common question that I get. Which life expectancy table should I use to calculate RMDs for an inherited account? The uniform lifetime table is used for most owner accounts. The uniform lifetime table assumes that the IRA owner has a beneficiary who's 10 years younger than they are. Now, if the spouse is the sole primary beneficiary and more than 10 years younger, then you can use the joint life expectancy table, and that would produce a lower RMD amount than which would apply if we were using the uniform lifetime table. But here's something to bear in mind. When the IRS issued instructions to custodians about calculating RMDs for retirement account owners, they told them several things. And the two that sticks out to me is, you don't have to calculate RMDs for a retirement account. That is not a compliance requirement as far as the IRS is concerned. So owner accounts, yes. Inherited accounts, no, unless you want to do it. And when you're calculating RMDs where the owner is eligible to use the joint life expectancy table, you can ignore that and use the uniform lifetime table. So you could have a scenario where your client might say, I want to take a lower RMD because I'm eligible to, but the calculation provided by the custodian would be incorrect in that instance because the custodian uses the uniform lifetime table. That's not always the case, but you want to be aware of that so you can double check, right? Reason number 2, beneficiary audits. Who is the beneficiary of a retirement account? Are they a designated beneficiary, a non-designated beneficiary, an eligible designated beneficiary? Because that affects the distribution option that is available to them. And you don't want to check who's the beneficiary too late, right? I've seen too many instances where individuals come forward thinking that they're the beneficiary when they're not, because the beneficiary designation form was not updated. I talk more about that in my beneficiary course, which is scheduled for, I think, about January, but keep an eye out for that. There was a recent case where an ex-girlfriend inherited $1 million because her boyfriend failed to update the beneficiary designation form for his 401k account. They were working together. They started dating. He designated her as a beneficiary. They separated after a year, and he did not update the beneficiary designation form. And when the beneficiaries of his estate tried to claim those assets, the court said, no, no, he wasn't married and he named her as a beneficiary. If he wanted to change it, then he would have. So as far as the courts are concerned, she inherited $1 million and she got married afterwards after they separated. So she and her new husband are enjoying that $1 million. Confirm who's the beneficiary after every life-changing event: marriage, divorce, death, new children being added to the family. And after that, identify which distribution options apply to a beneficiary. Is it the 10-year rule? Is it the life expectancy rule? Is it the 5-year rule? And if it's the 10-year rule, must they take annual distributions while meeting the 10-year deadline? That would be the case for a traditional account if the traditional IRA owner died after the required beginning date and the beneficiary is a designated beneficiary. Custodian level errors. And I'm not defending custodian just because I used to work for one. I'm talking about experiences here. I had a case where an IRA owner opened their account online and they inputted the wrong date of birth. As I talked about, using the uniform lifetime table instead of the joint life expectancy table. Misclassification of account. I just wrote an article for Morningstar where I explained a private letter ruling where the taxpayer, the IRA owner, got married, changed their name, asked the custodian to change her name, and while they were updating the account registration, they removed the word Roth from the account. And she continued to fund that account, thinking that this was a traditional IRA. It turned out that she had done millions of dollars in Roth conversions unintentionally because she thought the account was a traditional IRA when it was a Roth. So that's one of the things you need to do when you're auditing your client's IRA. And using the fair market value, this is technically not the custodian's error, but here's how this comes about. Someone takes a distribution in December, let's say of $1 million, and they roll it over back to the traditional IRA in January because they can, as long as they meet the 60-day deadline, right? And they're not breaking the 1 per year rollover rule. When the custodian does the RMD calculation, they're looking at the fair market value on their books and records. That fair market value does not include the $1 million, but it should. So now you as the advisor, you're going to create an RMD checklist with some questions that you're going to ask your client. And one of those questions has to be, did you take any distribution last year that you rolled over this year? Because if you did, we might have to do some adjustment to the fair market value. And if the IRA custodian calculated their RMD amount, we're going to have to take that and chuck it in the garbage because that's no longer good, right? Because it did not include, using my example, the $1 million. And using the IRA custodian's fair market value in that instance will result in an RMD shortfall. RMD aggregation mistakes. I would say this is in the top 2 mistakes that I see. Here's how this works. If you have multiple retirement accounts, there are some instances where you can calculate the RMD separately for those accounts, but you can take the total and take it from one or more of those accounts. And there are different reasons why you could do that. I have 3 kids. Maybe I like one more than the other, and I have 3 different traditional IRAs. I might say, I'm taking my RMD from IRA number 1 because that's the kid that I don't like so much. That's not true. I love all my kids equally. I like all of them equally. But there are different reasons why someone would choose to take distributions from one account over another. Can they? Yes, they can, providing it is permitted. What's permitted? If you have multiple traditional SEP and simple IRAs, you can aggregate RMDs, take it from any one of those accounts. Multiple 403Bs can be aggregated. Different employer plans, like different 401k plans, cannot be aggregated, right? But if you have different accounts under one employer plan, that can be aggregated. So it's very important that you know to make that distinction. The good news is that at the employer plan level, it's typically the plan administrator who administers RMDs. And if there are any shortfall, they usually help to correct those as part of the plan correction procedures. Beneficiary IRAs, RMDs cannot be aggregated with an individual's own IRA. And if they inherit, say they have multiple inherited traditional IRA, can those be aggregated? Only if they were inherited from the same decedent. So another item to add to your checklist to make sure that when you're helping clients calculate RMDs for inherited accounts, we make sure that we do the aggregation where it's permitted. Now, custodians are not required to calculate RMDs, as I said before, but many of them are starting to do that, sort of a service. But, with data entry, if you put the wrong information in, then the wrong information is going to come out, right? So when you're asking a custodian to calculate an RMD, or if they voluntarily calculate that required minimum distribution, you got to make sure they have the right information on their system. You need date of death of the account owner, date of birth of the account owner, date of birth of the beneficiary. Usually everyone gets that right. But you also need to let the custodian know if the beneficiary was disabled or chronically ill at the time of the IRA owner's death, and whether they're the minor child of the account owner. You also need to let the IRA custodian know if there were multiple beneficiaries of an IRA and whether separate accounting was done by December 31st of the year following the year of death. And if there were any non-person beneficiaries like a charity, did they take a full distribution of their share by September 30th of the year following the year of death. So bearing all that in mind, the thing we want to do right now, as we get to closer to the end of December, is avoid the December panic. I told you that I used to work at an IRA custodian, and let me tell you, you could never imagine what it's like behind the scenes as we get the increased volumes of R&D requests that are coming in, and advisors calling in saying, did you get my request? Did you process it? It's very frenzied back there. So now as advisors, we're going to have to take some responsibility for that. Get the request in early and keep checking and refreshing the system to see if the RMDs for clients have been processed. Reason number 6, why you want to do RMDs now: to avoid the 25% excess accumulation penalty. And if your client misses the deadline, take it as soon as possible so that it's reduced to 10%. Now, when Secure Act reduced the excise tax to 10%, many professionals were saying, now that it can be reduced to 10%, the IRS is not going to waive the excise tax anymore. And I've been saying that that's not true, because when you look at the language in Secure Act 2.0, it still said that the IRS will correct it if would waive the excise tax if the deadline was missed due to reasonable cause. And guess what? The new version of Form 5329 confirms that. So as you fill out the Form 5329, you'll see that there's an opportunity for the IRS to waive the 25% excise tax, and there's an opportunity for the IRS to waive the 10% excise tax. But I spend a lot of time trying to help people get a waiver of the excise tax. It's not a fun project. It's even worse when you find out that an IRA owner has years and years of missed RMDs. So you want to make sure that your client does not fall into that category by help them to meet their RMD deadlines. And this is where you want to say to your client, listen, I know I might not be your only financial advisor, but I want to help you make sure that you meet the required minimum distributions for all your other accounts. So tell me, what are those other account numbers? How much do you have in those accounts? And did you satisfy the RMD requirement for those accounts? If your client misses the RMD deadline, don't give up. Ask for the waiver. I've never gotten a no from the IRS. The only time I've gotten a no from the IRS, once a CPA came to me and said, Denise, you told me the IRS wouldn't waive would waive the excise tax due to reasonable cause. Turned out that the CPA filled out the form 5329 incorrectly. We fixed it, and then everything was okay after that. Got a letter from the IRS a few months ago telling one of my clients that we can't waive the excise tax for you because we have done this before. When he called the IRS, they apologized and explained that they had new people handling the RMD waiver process, and they sent him a corrected letter apologizing, saying they made a mistake. So if you get one of those letters from the IRS saying that they have denied the penalty waiver that you requested, call them. Usually can be resolved just with a telephone call. I also recommend putting it in writing so that, at least you have a record of it. Rolling over an RMD or converting an RMD. I'll give you a scenario because I get this call almost every January. Someone is supposed to take an RMD for 2024, for instance, from their 401k. They rolled over the entire 401k balance in 2024. They didn't take their RMD first. What we have now is an ineligible rollover of the RMD amount. You might think that's not a big deal, but I've seen RMDs of $1 million, $700,000. And when $1 million is of RMDs rolled over to an IRA and creates an excess contribution, that is subject to a 6% excise tax for every year it stays in the account, right? Subject to a statute of limitation of 6 years, which starts when they file their 1040. Now, if someone thinks that their rollover is accurate, they're not going to try to fix it, right? So they sit there and have the 6% excise tax accrue every year, which is one of the reasons why a taxpayer owes the IRS $8.5 million in excise tax right now, because they did an ineligible rollover and didn't fix it for many, many years. But back then, the statute of limitations started when you file Form 5329. One of the good things that came out of Secure Act 2.0 is that the statute of limitations now starts when you file Form 1040. And, as an aside, that taxpayer who owes the IRS $8.5 million went back to the IRS and said, well, now we have a new rule. The statute of limitations starts when they file their 1040. So why don't you roll me up into that? And the IRS said, no, we can't, because the Secure Act 2 provision was not in effect then when you made that mistake. One of the questions I get asked often is, say my client is supposed to take an RMD this year, and they did a Roth conversion without taking their RMD first. Can they satisfy the RMD after? The answer is no. Same thing with a rollover. So if your client has an RMD this year, they have to take the RMD first before they do a rollover, before they do a Roth conversion. And if they don't, then the receiving Roth or traditional IRA now has an excess contribution. How do you fix that to avoid a 6% excise tax? You contact the IRA custodian, you tell them, I have an ineligible rollover, or my client has an ineligible rollover of, say, $1,000. We want to do a return of excess of that amount. And the return of excess has to be done by tax filing due date plus extension, and must be accompanied by any net income attributable, which can be earnings or losses. And if you file your tax return by the due date, you get an automatic 6 months extension. Now, you miss the deadline for doing that, for doing a return of excess, then you're going to owe the IRS a 6% excise tax for every year it remains in the account. Now, we're in November, and if you're reviewing an account where the client missed the deadline, should we fix it? Absolutely. Because if you fix it now, it means that we don't have another 6% excise tax accruing on that excess. Coordinate Roth conversions. Roth conversions is the hottest thing right now when it comes to retirement accounts. I never advise on suitability. My friend, Nicole Mayholtz, she has a software that will help you to determine suitability. She runs Brentmark. This is not an advertisement. She's not on here. I'm just talking about the software that I use, and you must do your own research and use different software to figure out which one works best for you. But the reason why I mentioned that is you want to make sure that your client is suitable for a Roth, or a Roth is suitable for your client. Unlike what many advisors are saying, Roth is not for everybody, right? Hence the need to do a suitability assessment. After you've done the suitability assessment and all things are a go for your client, then you can do the Roth conversion. The question becomes, how much should you convert? After the client takes their RMD, then we know the entire balance can be converted. But should you convert the entire balance? Probably not. If you have a $100,000 IRA, it might make sense to convert $25,000 this year, $10,000 next year, and so on. Again, this is where you bring in the CPA into the conversation and say, what is the most tax efficient amount to convert for my client right now? I got to tell you though, most CPAs that I talk to, their question is, why do you want to pay taxes now when you can pay it later? So I'll leave you and the CPA to have that debate. Reason number 9, charitable giving and QCDs. IRA owner, this does not apply to any type of employer plan. An IRA owner can donate up to, I think it's 108,000 for this year from their IRA to a qualified charity. It can be done from traditional IRAs, inherited IRAs. It can be done from SEP and Simple IRAs that have not received SEP and Simple IRA contributions for that year. And it can be done from Roth IRAs too. And I know some of you right now are raising your eyebrows at me saying, Denise, what you talking about? You can't do a QCD from a Roth. Of course you can. Does it make sense? Most times it doesn't. But in an instance, if someone really wants to make the donation from their Roth, it would make sense if they're not at the stage when they're eligible for a qualified distribution, which would mean the earnings portion would be taxable if they take a distribution of it. And right now you're saying, but earnings comes out last. Not when you're talking about QCDs. When you're doing QCDs, earnings comes out first. So again, for Roth IRA, only if your client is not eligible for a qualified Roth IRA distribution and they want to make donation of up to the earnings portion. One of the things we got to remember is, even though an IRA custodian can use a code Y on the 1099-R to say to the IRS, we're processing this as a QCD, it doesn't mean that it's a QCD. For instance, your client might have after-tax amounts in their traditional IRA, say 20,000. The traditional IRA balance is 100,000, which means only 80,000 is pre-tax. And if they donate the entire 100,000, the custodian is going to report the entire amount as a QCD. But you and I know that only 80,000 really qualifies as a QCD because 20,000 is already non-taxable due to the fact that it represents basis. And that's where, again, the CPA comes in because they're going to have to claim that as an itemized charitable donation on the tax return. coordinating QCDs and required minimum distributions. I don't know why, but I usually get the call in about now saying, Denise, my client took their RMD earlier this year, but they want to make a QCD now. Can they? Absolutely. If your RMD say $1 million and you already took your RMD of $1 million, you can still make a QCD. But where the problem usually comes in is an advisor saying to me, oh, my client's RMD is 20,000. They took it earlier this year. Now they want to make a QCD at 20,000. Can they do it? Yes. Can that count as their RMD? No, because they already took their RMD. And remember the rule that says for any year that you're subject to an RMD, your first distribution goes towards satisfying your RMD. So here's a tip. If your client wants their QCD to do double duty by serving as a QCD and counting towards their RMD, do the QCD before they have satisfied their RMD. I'm not saying doing a QCD first, but I'm saying if the RMD is only 20,000 and they want to make a donation of 20,000 because they do that every year, they make a charitable donation, then do the QCD first. You do the QCD first, it covers the RMD, it's a non-taxable distribution, and after that, they can take additional distributions if they want to. And those additional distributions could be rolled over as long as it's not breaking the one per year IRA to IRA rollover rule if they want to do that. So, a recap, client wants to do a QCD. They want the QCD to also count as their RMD. Make sure the QCD is done before the RMD satisfied. If the QCD and the RMD amount is the same, do the QCD first. Then it counts towards the RMD and no additional distributions are required. But some clients will say, I already took my RMDs. I needed to cover my living expenses, so that's okay. And I still want to make a QCD of up to, say, $20,000. That's fine too. Reason number 10, year in accuracy and coordination. Cross-check Form 5498 and custodian reports. One of my clients, every August, he goes to his back office, the custodian, and say, run me a report of all my clients who are at least age 73 this year, and include in that report how much they have already taken as their required minimum distribution. This financial advisor gets his staff to double check his client's RMDs, make sure they're accurate. If they're not, they make sure that they take any corrective steps. And again, your client might not have taken their IRA RMD from the IRA that they hold with you. That's fine if they took it from elsewhere, because remember, under the RMD aggregation rule, they don't have to take the RMD from the IRA that they have with you as long as they take it from another permitted IRA. And keep documentation ready for tax preparers and clients. I'm telling people now that documentation related to your IRA, keep it in, say, a Google Drive or any secure database, because I'm finding that too many people don't know how much they contributed one year, how much they distributed one year, and all the other transactions that are related to their IRA. And custodians will keep documents, say, for about 7 years, and after that, they're not required to. And clients lose their documentation. So now we're going to make a concerted effort to make sure that clients keep this documentation. This is so important, especially for Roth accounts. When your client says, is my distribution from my Roth IRA qualified? I know Roth IRAs are not subject to RMDs for the owner. For the beneficiary, they are. So it could come into play right there. But overall, you want to keep all your contribution, 5498 statements, etc., and distribution reporting on the 1099-R for Roth accounts and for all your other IRAs. So what are some of the opportunities that you can do as an advisor to help your client. Remember, it's very likely that your client list includes someone who has either inherited an IRA and is subject to an RMD, or owns an IRA or an employer plan. So use an RMD review. That's when you call in your client and say, let's talk about your RMD and let's see if you are a good candidate for a Roth conversion. How about a qualified charitable donation? Do you make a donation to your church every Sunday? Did you know that you can do that from your IRA up to $108,000 on a tax-free basis? So now your CPA won't have to do all that song and dance on your tax return to let the IRS know that this distribution is non-taxable due to being a QCD. And of course, beneficiary and estate planning, death is a natural part of life, and there is an increased number of individuals who are leaving their retirement accounts to beneficiaries, or increasing number of individuals who are inheriting retirement accounts. And we have to be in the right position to advise them on what their distribution options are, because if beneficiaries don't take the required minimum distributions, they too are going to be subject to the excise tax. And most beneficiaries, when they inherit accounts, in my experience, they don't think about RMDs, because they don't realize that the fact that they inherited the account from someone, for instance, who died while in RMD status, means that they have to continue taking annual RMDs over the applicable life expectancy. I don't know if you agree, and I think you would, but an RMD process is such an important part of managing a client's IRA. My clients agree with me that it's not just about the investments, it's about helping clients meet their RMD obligations as well. That's one of the other important feature, and to help them avoid the excise tax and having to file Form 5329 and request a waiver. Because usually when a CPA files additional form, they charge extra for that, So do we want to pay extra for anything that could have been avoided? I don't know about you, but I don't want to. How do you help your clients? You send clients a personalized RMD calendar for 2025. It does not have to be fancy. Something that you type up on a letterhead saying, this is your RMD obligation for 2025. Now, if you need help with that, I can help you with that. Use calculations to avoid Roth conversion windows, review beneficiary designations, incorporate RMD discussions into your annual review, and provide QCD guidance. I find that when my clients send a QCD letter to their client, it speaks louder when they include examples of how RMDs can count towards their QCD. By the way, something I forgot to remind you of, QCDs starts when an IRA owner reaches age 70 and a half. So even though the RMD age has increased to 73, the QCD age still remains at 70 and a half, because they really had nothing to do with the other when they were both 70 and a half. It were different requirements. And offer an RMD checkup as a standalone service. One of my clients, their primary service, they don't do investments, but they do RMD checkups. They do Roth conversion analysis. They do IRA audits to check if there are excess contributions so that they can be fixed timely. So you could have someone in your office who handles that process. And trust me, as I think you would agree with me that a client will feel special that you're doing these additional service for them and their IRAs. This is some script I included. You'll get a copy of this handout. So this is just an example of some of the things that you could say to your clients about RMDs. RMD accuracy script, beneficiary audit script, Roth conversion window script. And I won't spend time reading all of that because, as I said, you're going to get a copy of the handout. So your checklist as an advisor, do like my client. Ask for a report from your back office of all clients who are at least age 73 and inherited, and those who hold inherited accounts. Find out how much they have already taken from their retirement accounts. That will help you to determine if they have already satisfied their RMD. And for those who satisfy their RMD, you can just cross them off your list. They're done. You don't need to go back to them. Confirm beneficiary designations and account titling. There's a myth going around that if a beneficiary IRA does not include the name of the decedent and the beneficiary disqualifies the account, you can tell anyone that I said that's not true. Okay, that's an easy fix. You contact a custodian, and as long as the account is plated otherwise as an inherited account, that's fine. Verify the fair market value, add back outstanding amounts. Don't assume that the fair market value that the custodian provides is correct. You want to double check that, especially if your client has outstanding rollovers and outstanding transfers. I explained outstanding rollovers, outstanding transfers would mean you start to transfer in 1 year and it gets completed in the following year. Use the right tables, review opportunities for conversions, QCDs, and get the CPA involved so that we can talk about tax timing, right? Tax efficiencies. Should I take my RMD this year versus next year if it's my first RMD year, for instance? Key takeaways: early planning prevents penalties, confusion, misstrategy, beneficial rules, and aggregation errors remain top compliance traps. I'm speaking from experience here based on what I see. Turn year-end chaos into proactive client engagement. And 2025 is the year to lead with precision and preparation. How do I help clients? I do beneficial reviews, I do RMD audits, I do rollover audits. I'll train your staff. I have a few clients right now that have new employees who are, starry-eyed and bushy-tailed, if that's how the saying goes, and they don't know what an IRA is. I remember when that was me. And so I know how to train these people. I'll do that for you. If you're depending on the level of consulting you have, if you're my client, you get that for free. I'll do calculations, I'll do compliance checks. And what my members get is monthly webinars. You're getting this for free, even if you're not one of my clients. Sometimes I do that, but most times I keep it private just for my clients. I give my clients letters where they can send out to their clients. They get it in a Word file so that they can make changes to it if they want to and add their brand to it. I provide checklists and decisions to you because you know what? IRAs are complex, and sometimes you just want to just look at a decision tree and say, is my client this, that? Then XYZ apply to my client. I have some handouts that I'm going to send out after the webinar. My top 5 R&D mistakes, my advisor R&D checklist, some Q&As, and the sample R&D letters, which will be made available only to individuals who attended this webinar. And if you want to sign up and try out my consulting services, just go to applebyconsultinginc.com or Denise Appleby.com and it will switch over to the website. So there's some ways that you could keep in touch. Please connect with me on LinkedIn. Visit my YouTube channel. I'm going to post a copy of this recording on YouTube channel. I know many of you buy my book that is updated each year. The limits have changed this year, so that's going to have to be updated, and that's going to be available at IRApublications.com. And this is the book that I'm talking about. I have some people who buy this book every year because they simply cannot do without it. I'll send out a notification when the new version becomes available. And now I'll take your question. I know I went fast because it's a lot to cover, but You can email me with questions, and if you're my consulting client, you get unlimited consultation under your membership. It starts at 900 per year, and I have clients who email me every day of the week. I also have clients who email me twice a year. It's up to you how often that you want to use it because it's unlimited. So let me take some of your questions. Can you aggregate traditional SEP or just traditional and SEP? You can aggregate traditional IRA, SEP IRA, and simple IRA. For RMD purposes, all of these are treated as one big old traditional IRA, right? Hope that answers your question, Earlene. I think I missed something. Can you do an RMD after a rollover? Um, I gotta use an example for this. So you have IRA number one. The RMD for IRA number one is 10,000. If you take a distribution and you're gonna roll it over, you gotta hold back the 10,000 or distribute the 10,000 first, right? Now, can you do an RMD after a rollover? Not for the same amount that was rolled over. Say, for instance, you have a 401k that is subject to an RMD and you roll over that 401k to a traditional IRA that was already in existence and have a previous year in fair market value, then you could take the RMD from the IRA after the rollover. But for the amount that was actually rolled over, the RMD has to be taken from that amount first and only the balance rolled over. For those eligible, is it correct to say do a QCD first, then an RMD, if not already used up to be a QCD, and finally Roth conversion? Um, that's a lot, Danil, but let me put it this way. If you want to distribute only the QCD amount and you want the QCD amount to cover your RMD, then you do the QCD first. If your RMD is 10,000 and you want to make a donation of 10,000, you don't want to take any more distribution than 10,000, then do the QCD first. But if you take the RMD first, you can still do the QCD afterwards, but in this case, the RMD is going to be included in income. I'm going to do a follow-up session just on QCD, Anil. So hopefully you sign up for that session as well, because it's quite a confusing feature I'm finding. We've been told that non-qualified beneficiaries of inherited Roth IRAs aren't required to take RMDs. Is that correct? It depends on what you mean by RMD, because if it's a non-qualified beneficiaries, and I assume by that you mean like an estate or a charity, which makes them a non-designated beneficiary, then they would be subject to the 5-year rule for an inherited Roth IRA. They don't have to take annual RMDs, but come year 5, the entire remaining balance is an RMD. And so, yeah, at that point, they're subject to an RMD. But if you're talking about annual RMDs, no, they don't have to. Is it advisable to name a beneficiary for an inherited IRA in addition to one's own IRA 401k? Absolutely, yes. Because if you don't name a beneficiary for your inherited IRA, then the IRA custodian is going to determine who the beneficiary is for you. And depending on who the custodian is, some custodians have a default provision that say if you don't name a beneficiary, it's your surviving spouse, if you have one. If none, it's your children. And if not, then your estate. And some just go straight to the estate. So not because it's a beneficiary IRA, you should think that, oh, I'm not going to name a beneficiary. The beneficiary that you name will not affect the calculation of the RMD for the inherited account, but it will affect who's a successor beneficiary of that inherited account. So absolutely, yes, please name beneficiaries for inherited accounts. What happens if a custodian applies the wrong life expectancy table, but distributions were already taken? Well, it depends. If the custodian applies the wrong table and less than the RMD was taken, then you got to make up that RMD as quickly as possible. And if it's a custodian error, that's a reasonable cause. That's definitely one of the reasons where I've gotten the IRS to say, oh, yeah, that's not your fault. We'll waive the excise tax. If the custodian's error resulted in more than the RMD being taken, then the amount in excess of the RMD can be rolled back into the traditional IRA. We got to be careful here, because if that rollover is going to break the 1 per year IRA to IRA rollover rule, then you can't roll it over. But you could roll it to an employer plan if it's not after tax amounts and the employer plan accepts rollovers. Or if you have nowhere else to put it, just put it in a Roth IRA as a conversion. It's going to be included in income, yes, but at least you put it in an account where it continues to be eligible for tax deferred growth. And don't tell custodians that I've said this, but I know of a few custodians where if it's their mistake why someone received more than the RMD amount, they have been known to correct it on their systems. But don't tell them I said that they'll do it, because that's a business decision, right? If a client inherited an IRA in 2020 and the dad died after his RBD, do they still have to take annual RMDs and empty it by year 10? Or did the new regulations change that? The new regulations actually say that the at least as rapidly rule applies. In short, if you inherit a traditional IRA from someone who died on or after the required beginning date, there's no stopping that RMD train. You got to continue. The only question is at what pace, right? The decedent would have been using the uniform lifetime table to take the required minimum distribution, unless an exception applies to use the joint life table. But the beneficiary must continue taking annual RMDs using the single life expectancy table. And if they are a regular designated beneficiary, not a non-designated beneficiary, not an eligible designated beneficiary, just a plain designated beneficiary, they have to empty the account no later than the 10th year following the year of death. No, in my beneficiary module, I'm going to cover like why is that an issue about should you take annual RMDs when you have only 10 years? Because if you take only the RMDs, then you're going to have this huge balloon amount to take in year 10. If the custodian didn't send an RMD notice at all, does that help with penalty relief if the client missed it? Yes, it does. But I would take a bet that as long as the date of birth and the account type was accurate on the custodian system, they sent out a letter. I've looked at many, many custodians and I've never found one that fails to send out RMD notification every year, as long as they had the client accurately reflected as someone who was at least RMD age. Can you explain again which employer plans can be aggregated for RMDs and which absolutely cannot? Traditional SEP and simple IRAs can be aggregated. Multiple 403Bs can be aggregated. Different employer cannot aggregate RMDs for different employers' plan. Multiple traditional SEP and simple inherited accounts that were inherited from the same decedent, multiple inherited Roth IRAs that were inherited from the same decedent. If a 403B has multiple custodians, do they calculate their own RMD, or can the advisor pick which one distributes? The advisor and the client can collaborate and decide which one of the accounts they would take that from. Because remember, the RMD aggregation rule applies to 403B accounts. What is the best way to document RMD calculations in case the IRS questions it later? Keep the IRA custodian RMD notification. Keep copies of whatever you use to calculate the RMD and the output, and keep that in an RMD folder. You can keep it online now, which makes it easier. If a client accidentally took too much as their RMD, can they put the excess back, or is that allowed within 60 days? It's allowed within 60 days as long as they're not breaking the one per year IRA to IRA rollover rule. But also Revenue Procedure 2020-46 allows a waiver of the 60-day deadline if certain requirements are met. So you can just Google Revenue Procedure 2020-46 and you'll see what the requirements are. Do successor beneficiaries still have to continue the decedent's 10-year schedule, even if they inherit in year 7 or 8? Okay, so what this person is saying is a designated beneficiary inherited an IRA and is subject to the 10-year rule, and they have to take annual RMDs because the owner died on or after the required beginning date. So the designated beneficiary dies 7 years into the 10-year period. What are the options for the successor beneficiary? Well, the successor beneficiary continues at the pace that the primary beneficiary was taking RMDs, or they can take more if they want to, but they're still subject to that original 10-year deadline that applied to the original beneficiary. I don't see any more questions. I want to thank you. If you have questions that you thought about after this, you can email me at IRAanswers@AskAppleby. Or if you're my client, then you already have my email address. If you're not my client, please don't make it specific. I can give you general educational information, but to handle specific client cases, then I can only do that if you are my client. I want to thank you for your time. Enjoy the rest of your day, and I appreciate you attending. Thank you.